Hi, this is Todd Baker, your certified mortgage planner. Today is September 23rd, 2019, and I'm going to give you a market update on interest rates. And I always like to include how it works as a preliminary education section in these videos. So first off, when you're going to get and buy a house and get financing, the interest rate of the mortgage is determined by multiple factors, but there's two primary factors that drive what type of interest rate you're going to have. The first one is your credit score. So as a consumer, it's pretty well understood that a better credit score will give you a better interest rate, a lower credit score will give you a higher interest rate. The A paper or prime paper for mortgages is 760. So if your score is 760 or above, that is the ideal scene for pricing. For a conventional loan type, when you fall below, each 20 points is a bucket for adjustment in price. And that's determined by Fannie Mae and Freddie Mac. That's not independently set by any bank, so it's all standardized. So when you fall below 680, what normally happens is the interest rates go up significantly on a conventional loan, and then an FHA, which is a government loan, starts to look good, especially if you're putting less than 20% down. FHA has pretty good pricing down to about 620 in a score, and if you fall below 620, that 580 to 680 bucket, interest rates are going to be a lot higher. Now, these interest rates are mortgage tri-merge reports. These are not consumer. So if you go to like Credit Karma or any of the credit card companies that offer scores, those are good indicators and good tools, but those are not mortgage scores. So you might have a high Credit Karma score and a lower mortgage FICO, and sometimes even vice versa, depending on the situation. So that's how it works. It's primarily interest rate. The second thing is the market, and how the market works is mortgages or bonds. They're traded in Chicago along with U.S. Treasuries. So they have the Federal Reserve, by the way, does not set fixed rate mortgages. The bond market determines that along with your credit score. And the bond market can go up and down each day. And so you need to be working with someone that understands how to read the bond market, has the tools to understand are mortgage rates likely to increase, are they likely to go down, are they likely to stay stable? Because when you find a house or you're doing a refinance, you have to lock in your interest rate, typically a period of time of 30 days. Now, where rates are at today are in the high threes for a 30-year fixed. Just so you know, one of the sort of schemes that advertisers do, most big banks in the United States that do heavy online advertising and advertise mortgage rates, first thing is they typically are going to put the lowest rate in the upper left-hand corner, because that's how you tend to read. But when you look, it's typically going to be a 15-year note or an adjustable rate mortgage or a 30-year paying points. Points are percentage points you pay up front to lower the interest rate. But all of those disclosures will be buried really low in really fine print that you can't see. So just know that in terms of uniformity, most banks are going to have pretty close interest rates, and that's not the best way to determine who to work with. You want somebody that understands finance and how to actually pay less interest and create wealth in the house. It's much more impactful than shopping for interest rates. So let me show you what the marketplace looks like. So this is a chart of that we use, and I have a subscription to this. This isn't a consumer-based thing. You have to pay for it, and as a mortgage professional. And this shows the mortgage-backed securities market. And you can see as these prices go up, rates improve. And if prices go down, rates decrease. So we had a period the week prior to last week where the mortgage market got hammered. And it was all over the news, all over the business channels. Oh, interest rates went up suddenly, worst week ever. And then they've sort of improved the last few days. And right now, they've opened up nicely this morning. So I'm able to basically take the news, see what news is going to come up for the next week. If you see right here, we have a news feed, okay, and it shows us the economic calendar, the impact, what's going to happen. Mostly this week, it's mostly moderate impact, except for the GDP, which is coming up, which is a high impact. That's on Thursday. And then you have personal consumer expenditure and core CPI. The inflation reading Friday is a high impact event. So I understand when I get a file how to read these charts, what the news are, and should we lock in the rate. So we also have a policy at Service First that allows us to renegotiate your rate in the event that, so I actually have the ability to lock in my clients to protect them. And then in the event the market has a significant improvement, renegotiate that rate. So you get the best of both worlds. So it really pays to work with someone that knows what they're doing. If you'd like to work with me, please feel comfortable reaching out to me. I'd be happy to take care of you. Have a wonderful day, and and if you, like I said, if you have any questions, give me a call. Thanks so much. Bye-bye.